The 2008 financial crisis led to a new era of regulation for banks and insurers. Now, it's 7 years after the financial crisis, and we're just coming to the end of the regulatory process. Surely the crooks and the baddies have moved on since then, but South Africa has been no exception in terms of catching up with regulation. Our regulation is coming in the form of something called Twin Peaks, and it's got nothing to do with a bad TV show of 20 years ago. This is the MoneyMakers. I'm Bruce Whitfield, and I'm joined by Professor Robert Vivian, who is Wits School of Economics and Business Sciences professor. We were hoping to talk to the Financial Services Board, but they've had a last-minute engagement. Are they scared of you, do you think, Robert Vivian, these Financial Services Board types? Because you are pretty direct in your criticism of what's going on right now.
I don't think they're scared of me. We're quite good friends. We just never seem to get the opportunity to have a public debate. but we are good friends.
What is the issue with Twin Peaks? Because here we've got new regulatory regimes around the world. 2008, the world nearly falls apart. It's held together with a piece of bubble gum and a piece of bootlace, second-hand bootlace, and some sticky tape. And Ben Bernanke starts printing money, and he drags the world from crisis into debt. And then we think, we need to stop that from ever happening again. So regulators around the world get together in smoky rooms and start devising new ways to prevent that from happening again.
Well, it's not the new ways. You see, it's the old ways. What's new is the regulatory system. So if you say, what is Twin Peaks? There are two peaks of regulation, two people that, or parts that the regulators concentrate on. The first is prudential regulation, so you don't want banks to fail. And that's what failed, or that's the regulatory feature which failed in the crisis, because the banks did fail.
Yeah.
And then the other one, which is for more recent, is market conduct, which is you want to teach your customers fairly. Now, both of those peaks exist at this point of time.
Now, where do they exist right now? Because for consumers of financial services, they've got an ombud process perhaps, but they don't necessarily feel protected. The idea of Twin Peaks and greater guarantees and greater protection sounds good. Why is it not?
No, they exist within the FSB at the moment, so that they are regulated holistically. The FSB looks at prudential and it also looks at market conduct. So they exist. What is new is the idea that we should split these. You know, send the prudential to the Reserve Bank, and FSB being renamed then looks after just the market conduct part. Now, my concern with this is that splitting it is going to be a mistake. And it's really the UK that's caused the split, and we're really trying to fix the mistake that they made.
Why has the UK made a mistake? What's happened in the world of regulatory regimes that the UK has misstepped on?
Well, we have to go back to see the mistake which happened in 2000 when they created the FSA, which we never followed that mistake.
Financial Services Authority in the UK, yeah.
And we were invited to follow that, and we declined quite correctly. And what I'm saying is we should decline to follow them now as they try to fix the mistake up. Because what they did in 2000 is they created a single holistic regulator for all financial services and all the peaks together. So when the financial banks started to fail, it hadn't focused on banks at all. It hadn't focused on prudential risk management. It had developed a sort of market conduct. And so it was totally incapable of dealing with the bank failure. And so what they decided, the Conservative government decided when we got into power, is to send the prudential regulation back to the Bank of England, where it should have never left. So that's where the split is coming from.
I mean, our banks are regulated at the Reserve Bank already.
Precisely.
So the Registrar of Banks sits at the Reserve Bank, is a very senior figure within the Reserve Bank, and makes calls on regulation based on what's happening globally on a daily, weekly and monthly basis.
Yes, now what happens is they want to send insurance companies and pension funds to the Reserve Bank.
But insurance companies and pension funds, even the difference between banks and insurers and the way in which the businesses operate, the way in which they calculate their profits, the way in which they sell their products is fundamentally different. You add pension funds on top of that, although it's related perhaps to the investment industry, it's also a very different discipline.
That's the problem. You see, these things are completely different. And so what you should do is regulate them holistically and within one thing. Don't split the two peaks. And so the mistake is trying to split these two peaks. So
now, it's become something of a national obsession, and it is happening, whether you like it or not. It is going ahead, right?
Well, it hasn't been passed yet, so maybe it can still be stopped. So I'm a perpetual optimist, you see. And if you say it's happening, well, it's going to happen temporarily, because when the next failure comes in, they'll realize it and fix it up a bit better. and then split the peaks and put insurance companies and regulate them separately, pension funds separately, and do everything as it were. So it's a temporary hiatus until they realize the mistake.
There were very impassioned arguments made by yourself and Leon Lowe from the Free Market Foundation saying this is the dumbest thing we could do in terms of regulation. You didn't use the word dumbest, I'm paraphrasing, simply because it's massively expensive. What it does is exclude, particularly in the financial advice arena, a whole bunch of new entrants, particularly black financial advisors, to the market, because it just makes ticking the boxes very, very hard to do.
Yeah, I mean, the part of that is exactly what you sort of, we are now going to regulate market conduct. Now, the way to do it is to say, let's regulate insurance companies, let's regulate intermediaries, let's identify their unique characteristics. Now we regulate the whole lot, and it's a one-size-fits-all. So we put intermediaries under the same rubric. It just doesn't fit. Intermediary is not a bank, it's not an insurance company. So the net result, you put this very expensive system onto intermediaries, and then you knock out all the lower entries, which has now happened in the UK, New Zealand, and will happen in South Africa. And those mainly in South Africa would be the blacks.
No, but when one looks at the way in which the Financial Services Board works, and there's some very, very clever people within the Financial Services Board, people who worked within industry and have now gone into regulation, and that relationship actually seems to be quite good between industry and regulators. Regulators understand their role, industry understands the role of regulators. Why are the regulators going along with this? Is it a political imperative that is driving this desire for greater control?
Partly, but I think what they're trying to do is to follow the UK. So it's not so much that they've created a system they think is workable. It's the UK's gone down the system, and they're just following the UK. So the UK is split it, sent the Prudential to the Bank of England. So what we will do is we will send it to the Southern Reserve Bank. But bear in mind, the reason why they sent Prudential Risk Management or Prudential to the Bank of England is because they mistakenly took it away from the Bank of England in 2000. We didn't make that mistake, so we shouldn't be sending something which is not necessary to there. And bear in mind, the failure which we saw in 2008 was a banking failure. So what you should do is concentrate on making sure banks don't fail. They have a unique set of problems.
And we have in South Africa. I mean, Errol Kruger, before Rene, the current regulator of banks, very effective, very firm, very strong regulators.
No, precisely, because I think what happened in 2000 is the FSB would have approached the Reserve Bank and said, in following best international practice, we should regulate banks. And I'm sure that the Reserve Bank regulator told them that's not going to happen in South Africa. Now, we don't seem to have that sort of clarity of thought at the moment, where the Reserve Bank says, sorry, we're not going to take insurance companies, we're not going to take pensions. We're going to concentrate on that institution which has caused the price problem throughout the world and has done it repeatedly, banks. So let's look at banks.
And also, it feels like this is the horse not only bolted, but it went out into the field and it procreated, and it's got 7 generations of little foals running with it in the field outside, and now we're closing the barn door. This is 7 years after the financial crisis, and we're dealing with 2008 crisis problems 7 years later.
Yes, but you see why we have to do it is because in the UK, the Bank of England was not regulating banks, and you couldn't leave it where it was, which is a failure. So they had to do it. And now because they've done it, we've said this is best international practice, we must do it as well. What they haven't worked out is the UK was fixing up a mistake. Now we are now making a mistake instead of sorting it out ourselves.
So, I mean, are you getting any traction with your arguments within the National Treasury, within the Reserve Bank, within the Financial Services Board, where they're saying, Prof, you're just being a little bit difficult. Leave it to us, trust us, we're in charge.
No, I'm not getting much sort of, they're not seeing the light from that perspective, but it doesn't make much difference because the argument that I have is the one that is correct. So as I say, a couple of years from now when we get the next crisis and they realize actually they should never have sent insurance companies and never split them, then they will go back and then we will come back. So in the end, I would, my argument would win. So that's
but this is this not an argument of academia versus real world?
No, this is real world versus there's 2 ways you can solve a problem, you see, and this is the one is the academic way. And the academic way is to build on what Isaac Newton did. He said, if I have seen further than any other man, it's because I've stood on the shoulders of giants. So it's to understand the process and see where we've got. And the other more modern way is what I call the rule of jolly good ideas. So I have a jolly good idea. Let's split the peaks. So it doesn't work. It's not going to work.
But if we look at economic history, we should be learning lessons from economic history as opposed to simply responding with the jolly good ideas principle.
Yeah, your knee-jerk, let's go and follow the UK. Yeah, I mean, economic history once has done split them, because this is what Churchill, this is what I call the Churchillian legacy, because in 1906 he even piloted the British Insurance Act through Parliament, because what they had done a couple of years earlier, they passed the Life Insurance Act, and then they were going to pass the Short-Term Act, the Motor Act, the Marine Act, and he said, no, one market, one regulator, holistically. So if you wanted to follow the lesson of history, one market, one regulator, don't split the peaks.
I don't mean to dilute your message at all, because Churchill was a very clever man, but there's there's a new book out by a private banker turned historian who's gone into Winston Churchill's personal finances and found that he lurched from crisis to crisis in his own personal finances. And the one thing that he did do, and they've looked at the receipts from Berry Brothers and Rudd, the liquor merchants, and in today's money, the Churchill house, between about 1906 and 1914, was spending about 2 million rand a year on wine alone. Maybe our regulators should drink more wine. Perhaps that is the fuel that they need. Professor Robert Vivian, who is from the Wits School of Economic and Business Sciences, thank you very much for joining us. I'm sorry that the Financial Services Board couldn't make it. It would have made for an enticing confrontation. But we look at the way in which the government hopes to protect your money. More ways tomorrow. Maybe tomorrow they'll come on, or next time, or the time after. But we certainly need to get the Financial Services Board on. You're invited. Good night.